The Fed cut rates by 50 basis points after a long stretch of monetary tightening. Now that the dust has settled, we can truly digest the impact and what it really means for the markets, investors, and consumers. Was the rate cut a bit too aggressive? Well, today's guest says it might look a bit premature. We'll find out why right now on UBS Trending. Hello again, everybody. Thank you for joining us. I'm Anthony Pastore. Welcome to UBS Trending. Please join me in welcoming today's guest to the show, Octavio Morenzi, CEO and founder of Optimus. Octavio, nice to have you joining us. We're sitting here. We know that the Fed has cut 50 basis points here in the U.S. Let's just take a moment now that the dust has settled. What are your thoughts once you sort of take in the numbers, you see what Fed Chair Jay Powell said during the statement and his press conference? What is it that you're seeing right now?
Well, I guess the initial reaction to the rate cut, and it was a bigger rate cut than many people expected. Some people were expecting the full 50 basis points, but a lot of people weren't, thought it'd be 25 basis points. I think the initial reaction of the markets was relatively tepid, and now what we've seen since then is basically things start to accelerate and people digesting this and saying, yeah, this is really good for the markets. This is going to boost most stock indices, most stock prices, but particularly sort of growth stocks that have longer term prospects out into the future, technology stocks and things of that sort. So for that segment of the market, this is really good news. It's good news for the market overall, I think. I do think it was a bit premature because usually the central banks, they start to wait for clearer signs of an economic slowdown before they start to aggressively cut interest rates. And I think in the US economy at the moment, we don't see many indications of a slowdown that would justify now starting to aggressively cut interest rates. We see markets at record highs. We see housing prices going up, also in many locations at record highs. We see unemployment remain very low. We've seen a fair amount of wage inflation recently. The most recent reading was 4.8 inflation in terms of wages. And then if you look at the sort of core inflation numbers for the CPI and the producer price index, they're running at over 3% once you strip out energy and food and the more volatile aspects of that. So all those things add up, and I don't really see an argument at this stage for cutting interest rates aggressively. And bear in mind, central banks, once they start to go down a particular path, they like to continue down that path for at least half a year to a year. And so I think that's what we're going to see the Fed trying to do in this case as well.
Yeah, it looks like the Fed put out their a summary of economic projections, and it looks like they're looking at a 100 basis point total cut by the end of this year, another 100 by the end of 2025. What do you think this means for the broader economy, Octavio? Because you really did lay out some very important data points about jobs still being near record lows on the unemployment side. Inflation seems to be cooling. Just paint the picture for us.
Well, I think this is the rationale behind a rate cut at this stage. I don't think is as strong as in previous rate cutting scenarios. So, as I said, usually the central bank starts to wait for things to sort of cool down more substantially, and you start to see signs of a recession and things starting to go wrong. And then the central bank says, okay, we need to cut rates now to get things back on track and boost those segments of the economy that need more borrowing and are sort of dependent on credit. So that is what typically happens. This time round, it doesn't really look like that. It looks a bit different. I think most economic indicators are pretty positive, and most prices are very high. So I mentioned stock prices being record highs, housing prices are high, consumer prices in general are high, and not really coming down that much. I mean, the headline inflation rate, yes, but the core inflation rate is stubbornly high at over 3%. So the Fed is not where it would like the economy on the macroeconomic side to be to engage in this kind of rate cutting. So I'm afraid not really, it's very, very hard to see what goes on in the minds of the central bankers, and sometimes they're fairly opaque and obtuse in terms of their explanations for doing things. But I think what we might see in this scenario is the Fed, as soon as we see an uptick in inflation, sort of run for the doors and say, oops, we made a mistake, we cut too early, we need to now stop cutting interest rates or even start to raise them again. And I think the balance of risks point at that, really, that we're going to see the Fed undo this and say, oops, we were premature in terms of starting the rate cutting cycle, we need to move in the opposite direction. And that would be very bad for markets indeed. I think the markets would have a little hissy fit if that were to happen.
That's putting it lightly. And as we were talking about right before we began, there is, there's some measurement in the market, or some sentiment is more the word I was looking for, that the Fed could cut at every meeting until December 2025. So, that idea of the hissy fit really would play into that particular thought process. What are we not seeing here, Octavio? What is the market seeing that we're not seeing?
Well, I think the market has it right. So the market is basically saying that central banks, when they start to go in a particular direction in terms of monetary policy, being either increasing rates or decreasing them, tend to carry on moving in that direction for some time. And that is what the bets are this time as well, that this is going to be just like in all the other cases, that once the central bank starts to increase interest rates or decrease them, they tend to carry on in that trajectory for at least a year or 1.5 years, and they move in that direction. And so I think the markets are basically saying, well, that's what the bank's always done in the past, and so that's what we expect them to do this time as well. However, this time, inflation's a good deal higher than in previous rate-cutting scenarios, and the economy is doing substantially better, and the markets, of course, have never been so high. So that does not really add up, in my mind, to the optimum environment to start to now cut interest rates.
Yeah, and even in his press conference, Jay Powell made the comment that this was what he called a recalibration of policy when he talked about the cut of 50 basis points. But he did continue to stress data dependence, that the Fed will continue to look at the data because, as we know, and we've seen this with CPI over the last year and a half, it's not linear. It doesn't always just go down in one direction or up in one direction. It could waver throughout. So there are some risks there with this sense that the Fed could continue to cut.
Indeed, and I like the way he uses the word recalibrate, because that sort of suggests that he has a mathematical model there, and they plug in the numbers and they tweak around in the mathematical model, and it spits out what the interest rate should be. Now, I think many economists think that's the way it should work, but in reality, these decisions are very subjective, and a lot of gut feeling and instinct goes into it, rather than really carefully looking at all the numbers. And a fair dose of politics are involved as well, I would say. So it's not as cut and dry as you might hope, as you might believe. And certainly when they start to use words like recalibrate, you sort of get the instrument, there's some sort of instrument there, and they're tweaking around on some dial, and out comes the number. In reality, it's basically the members of the Open Market Committee get together, and there's a lot of gut instinct and sort of feeling, and more than anything really, more than really these econometric models that they've developed over the years.
Right. Yeah, Powell has always been one to choose his words very carefully when he's speaking to the public. Good point. So let me just switch gears with you just a little bit, Octavio. Everyone knows we've got the election coming up in the United States in just a few weeks at this point. And one thing we know more than anything is the markets and voters do not like uncertainty. So if we don't get, because obviously there's a very high risk that we could have a contest of who the actual winner is because it's such a tight race. If we don't get a decision on the winner for days or even weeks, give us a sense of what you would expect from the markets overall, even if that could impact the direction of monetary policy.
Well, I don't know about the impact of monetary policy, because I think monetary policy, there's always a lag effect. But if there's uncertainty in terms of the presidential election and the results, and it might well be the case, I think markets will respond very, very negatively. I mean, we saw this very clearly in 2016 when Donald Trump won. There was a sort of a period there where you weren't really sure, did he actually win? And is Hillary going to concede? And markets responded very, very badly to that. Once it was clear that Trump had won, they roared up and basically said, oh, this guy has a bunch of policies that basically look good for the markets in terms of cutting regulation and reducing taxation. His policies this time around are a bit different, but back in 2016, that is how the market responded. But so basically, uncertainty the market doesn't like. And I think in this situation, I'm not a political pundit by any stretch of the imagination, so I don't really know, but it looks more and more likely that both sides, and neither side is going to be willing to concede a loss if they do come out at the bottom in second place. So it might well be sort of a scenario where for some time it's uncertain who's really won, and there's a lot of back and forth in the courts and a lot of fighting out, and the markets do not like that at all. And I would expect that is the likely scenario that I'm looking at least for a period of a month or two, that there's some certainty and markets are down as a result of that, and trying to figure out who has actually won and who's going to be the new president.
Yeah, that's a conversation that we've been having quite a lot around here. Our chief investment office is talking to our advisors and clients about preparing for potential volatility following the election, and exactly what you said, if one side or the other does not concede, there could be a period of some volatility there. Just as we're wrapping up, Octavio, and back to the Fed and the 50 basis point cut, markets on the day were muted, but in the sessions that followed, they certainly looked like they liked the cut. Markets were going up, Treasury yields were rising. When you think about the overall sectors in any of the asset classes, where do you think you'll see the most benefit from this cut and continued cuts?
Well, really, the sectors that benefit the most are those ones that have sort of long-term prospects, earnings way out into the future. And that's going to be technology stocks, growth stocks, things of that sort. So any kind of be a bond or an equity or anything that has sort of longer term, basically things that are going to pay off years into the future is going to benefit very, very well from this. Those stocks that will not benefit as much are the ones that generate more immediate dividends and generate their cash flow in the short term. They would see little change as a result of this. But if your earnings are way out into the future, a lower discount rate is very beneficial to you. It increases the net present value of your cash flows. And so those are the kinds of stocks and bonds and financial instruments that do very, very well in this kind of rate cutting environment. So it's basically technology stocks, growth stocks, things of that sort.
Excellent. Octavio, thank you so much. We always appreciate you making some time for us. Thanks for being here.
Thank you.
Thank you, Octavio Morenzi, who again is the CEO and founder of Optimus. Thank you, Octavio. And for more information on anything that we talked about today and also the content coming out of our Chief Investment Office here at UBS, visit our Insights website. That address is ubs.com/views. Plus, you can give us a follow on Instagram. Our account there is @UBS Trending. Lots of great content. Plus, UBS itself as a firm is all over the other channels, LinkedIn, Facebook, YouTube, and X. So make sure to give us a follow there. And if you have any questions about your portfolio, make sure you're talking with your financial advisor. From New York City, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.